I'm Justin Boyd, President of Delta Financial Advisory, a registered investment advisor. We provide wealth management and investment advisory services grounded in unbiased analysis of the economic landscape and financial markets, combined with a holistic approach to financial planning. Welcome to our monthly market update video series. We'll review the prior month's economic and market data and provide our thoughts and outlook going forward. If you'd like to learn more about Delta Advisory, please visit our homepage at deltafinancialadvisory.com and complete the contact request form. If you find value in today's content, please like this video by clicking the thumbs up icon and consider subscribing to our channel. Okay, let's get started. We'll focus on several key topics this month. First, the continued strength in many headline economic indicators, while also reviewing some weakness below the surface. Second, the Federal Reserve's latest economic projections and our view on important components of the December press conference. We'll then take a step back, looking at the larger economic landscape from a 30,000-foot view, and conclude this month's market update with our current asset allocation. Incoming headline economic data remains healthy, particularly coincident and lagging indicators. GDP continues to grow at a 3% real rate and 5% current dollar pace. Current estimates of GDP suggest it will conclude 2024 at these levels as well, in line with our view discussed last month surrounding the possibility for structurally higher nominal GDP growth for some time to come. CPI continues to cool, albeit at a slower pace than many may have been expecting. Hourly earnings also continue to grow at a healthy nominal rate of 4%. Money supply growth and commercial credit expansion continue to return to long-term historical trends after the shock of COVID-era policies. One notable negative surprise has been unemployment, which ticked up in December and could soon retest momentary highs experienced earlier this year. Rolling up our sleeves a bit, though, we begin to notice some technical aspects of leading indicators that should be noted, as well as new and continued weakness in other areas of the economy. Revisiting our inflation slide from a few moments ago, I'd like to highlight the burgundy line at the bottom of the chart. This is the Consumer Price Index less shelter inflation. The considerable difference versus headline CPI and the sticky price index is immediately noticeable. In fact, while headline CPI has increased 2.7% year over year, headline CPI less shelter has only increased 1.6%. This really demonstrates the outsized impact housing has had on official inflation numbers over the last several years. As we discussed last month, on a national basis according to Zillow, rents continue to remain flat and many housing markets across the country have been in outright decline. Not only have housing prices decreased in many areas, but rents have actually declined as well. This is certainly not a regular occurrence, and it's our expectation subdued shelter costs will continue to have a sizable impact on anchoring inflation through 2025. At a broad level, controlling housing costs was a huge portion of the Federal Reserve's efforts to achieve their dual mandate. At this point, particularly with the recent shift in expectation for rates in 2025, it's our view that this has occurred in the near term. Moving in on our research efforts beneath the headline numbers, in its most recent release, the Conference Board's formulas continue to support an economy that is no longer in danger of recession. While this very well may be the case, we would point out that the large gains seen recently in the index, particularly in the most recent release, were a direct result of an uninverting yield curve and a slowing in the rate of decline of new manufacturing orders. A more detailed review of manufactured consumer goods, durable goods, and non-defense capital spending all show negative year-over-year growth. Additionally, construction spending is experiencing notable slowdowns at the aggregate level, with non-residential activity being the sole positive contributor on a quarterly annualized run rate. Residential, manufacturing, and total construction spend all show negative annualized growth rates. Another significant data point is the declining rate of growth in real personal income. The chart displayed here shows year-over-year changes in real personal income dating back to 1960. A visual review of the chart makes apparent that when real personal income falls below 2.5% year over year on a quarterly basis, a recession is often closely associated. While we won't validate a statistically significant correlation today, we certainly appreciate this straightforward, long-term visual representation of financial history. Zooming in, we see that the latest numbers show we are sitting right at this threshold. Last but not least, we can observe the notable cooling in the labor market that was discussed on numerous occasions during the FOMC's most recent press conference. More to follow on that. For now, the most important note is that the number of job openings has returned to pre-COVID levels, as this chart clearly displays. We consider all of these metrics just discussed that lie below the surface of economic headlines to warrant investor attention and integration into any prudent investment thesis with a capital preservation component. Let's move on to discuss the Federal Open Market Committee's most recent economic projections and press conference. The most glaring outcome of the most recent meeting was a sharp adjustment to bond yields and equity markets, with the realization that rates may truly remain higher for longer, particularly over the next 12 months. Two things we won't do here on a regular basis at Delta Financial Advisory: tout our as we predicted calls from previous periods, or try to predict short-term movements in interest rates. However, in this case, the sharp adjustment in rates was so immediate in following our adjusted range interest rate segment from last month's update that a visual review and brief discussion of this shift helps the viewer appreciate what transpired in market expectations. Shown here is the dot plot from the September projections of the Federal Open Market Committee and as displayed in our previous market update. You'll note only a single projection for a federal funds rate above 4% in 2025, and only 4 projections for a longer-term federal funds rate above 3.5%. There were also 33 total dot estimates from participants for rates over 3.25% for 2025 and beyond. Let's fast forward to December, where the FOMC's projections now show 4 estimates for 4% or greater federal funds rate in 2025, 44 projections for 3.25% and higher from 2025 and beyond, as well as 6 estimates for the federal funds rate to reside at 3.5% or higher in the longer run. This material trend change was the core thesis communicated in last month's market update. Chairman Powell went on to make several notable statements in the press conference that should be of interest to market participants. Quote, "We've had a year-end projection for inflation, and it's kind of fallen apart as we've approached the end of the year," end quote. Referring to inflation in 2025, he went on to say, "It's still going to be between 2.5 and 3. He also made a notable statement that, although not groundbreaking, should absolutely be noted by investors. Quote, "We're not trying to make decisions about the longer run, we're trying to make sensible policy as we go." So what does that last statement really mean? In our view, it means you're on your own, and prudent and insightful financial advice will be as valuable as ever going forward, if not more so, as we enter uncharted territory in many aspects of the fiscal and economic landscape. I would additionally add that some nuanced language in the chairman's responses surrounding the neutral rate and the R-star level certainly seem reminiscent of the transitory stance of the Federal Reserve several years ago. I don't suggest this from a flawed policy perspective, but rather from a time perspective that ultimately exceeds the rational expectation and patience level of many market participants. Put another way, while higher for longer may not mean the next 30 years, and it certainly wouldn't preclude a meaningful drop in rates if economic stimulus were required, a secular shift to higher rates certainly seems possible. One thing I'd like to make clear is that we certainly will not jump on the popular trend to bash the Fed. I certainly don't envy Chairman Powell's or the committee members' current position. Their job is to act in a leadership capacity, and that will always result in upsetting different segments of society at different times. I would note that I continue to applaud them for utilizing proven forecasting techniques to the best extent possible, but also not falling into the trap of trying to predict markets in the same manner as a profit-motivated participant. This disciplined approach requires they wait for data, just as they're doing, and as Chairman Powell said last month, not to assume, guess, or speculate. Moving on, Chairman Powell specifically mentioned headline CPI as the ultimate goal during the press conference, because that is what the average citizen ultimately feels. This was very interesting to hear directly confirmed by the chairman, particularly considering the press core PCE ultimately receives in financial circles. Why do I mention this today, and what does it ultimately mean to investors? I would suggest that remaining open-minded and pragmatic to what particular metric may best represent the current state of inflation in aggregate or in relation to pocketed inflationary concerns will likely serve market participants well going forward. Wrapping up our review of interest rates and the Federal Reserve meeting in December, Chairman Powell repeated that the committee still believes current rates are meaningfully restrictive, despite being closer to a neutral rate. Additionally, he ensured to communicate that 2 or 3 months of data shouldn't necessarily change their current position on policy. I would agree with their assessment of meaningfully restrictive, as well as Chairman Powell's statements surrounding policy outlook. While the financial markets are inherently volatile, having a level-headed and plain-speak chairman is something that remains a net positive to today's markets, in my opinion. Taking a step back and looking briefly at the global macro environment, we find several large aspects that cannot be ignored. Many large global counterparts continue to enter or spiral recession, notably China. China has undertaken large stimulus efforts to stabilize and support growth, but the ultimate effects are yet to be seen. China's sovereign bond yields have plunged recently, potentially indicative of truly larger problems brewing below the surface. Brazil, Germany, and the EU continue to experience significant challenges. All the while, the US continues to print massive budget and current account deficits, in part a large byproduct of serving as the global reserve currency. While the reserve currency privilege benefits the US in many respects, during times of global volatility, it drives capital to the US at an outsized pace, as is evidenced by the current problematic strength of the US dollar. Should these dynamics continue at their current pace, some variation of a financial crisis or additional liquidity to weaken the dollar remain the likely outcomes. Additionally, make no mistake, a material support for American equity markets is comprised of non-sovereign foreign buyers who have been steadily increasing their investments for some time. While the significant decline of foreign sovereign buyers of U.S. Treasury debt received the primary press, this is simply not the case for non-sovereign foreign buyers of U.S. equity. The party certainly could come to an end if the recycled flows back into the dollar and American financial and real assets were to reverse. This reversal could be caused by a U.S. recession or, to a lesser extent, surprise relative strength or jurisdictional advantage elsewhere in the world. I'm not here today to suggest that this is imminent or even probable at this point. At present, certainly, the dollar collapse bugs have been incredibly wrong for a very long time. We're not interested here in trying to identify a particular point in time for this sort of event and appreciate the reality it could occur far enough into the future to be a non-material input for today's investment strategies. However, as prudent and experienced market participants and a fiduciary to client capital, we remain observant for low likelihood, high impact inputs to the system and maintain the flexibility in asset allocation to hopefully absorb such an event and pivot to preserve client wealth. I would suggest that the present levels of our current budget deficit and national account balances as percentages of gross domestic product certainly remain on that short list, particularly when compared to history and other global examples. Moving on to our asset allocation, before we wrap up this month's market review, we ultimately maintain the same asset allocation as last month, namely, a moderate underweight in equities and a material underweight of duration. We do see a number of potential drags evolving under the surface for U.S. growth, as discussed earlier in this video. However, these are potentially offset by a still dovish bias at the Federal Reserve, as well as increasing money supply and commercial lending. Timing and impact for increased liquidity versus potential slowdown factors remain to be seen. Additionally, in our view, major equity indexes do offer somewhat of an equity risk premium if you factor in the impact of share buybacks. Given that these ultimately transfer balance sheet wealth to a valuation equation, even more highly dependent on the earnings input, we remain cautiously biased, given the already elevated valuation levels, and maintain our stance that a continued pullback from the recent highs of approximately 10% is entirely possible. Excluding share buybacks, we see no additional risk-adjusted incentive for equities at the index level, other than as inflation hedges. Given current inflation metrics and downward pressures, further inflation risk is largely absent from our immediate outlook for 2025. Conversely, U.S. Treasuries likely offer considerable real return over the short to intermediate term. We also continue to maintain our view that appropriately compensated credit risk beyond U.S. Treasuries is relatively scarce at this time. Of note, we did exit our energy-related positions last month. These were purchased primarily as a higher-yielding inflation hedge and have served their purpose well over the last several years. More recently, though, considerable technical consolidation in oil and a variety of other commodities presents us with some concern for the direction of these prices going forward. Should inflation reaccelerate in 2025, this exit may prove to be an overly conservative call to protect principal. However, we continue to be open to the possibility of a global financial contagion and a U.S. recession. As such, we maintain a moderately conservative bias while awaiting more attractive long-term entry points in the equity market. Thank you for watching. I hope everyone has a healthy and successful 2025. Thank you for watching, and I hope you gained value from this video. You may notice that some detailed information surrounding our specific asset allocation and portfolio holdings are not shared. This is out of respect for our existing clients. Should you like to learn more about Delta Financial Advisory, please visit our homepage at deltafinancialadvisory.com and complete the contact request form. We offer a complimentary consultation to explore if our investment philosophy and portfolio strategies may be a good fit for you.
Disclaimer: the information and commentary contained in this video are for general informational purposes only and do not constitute financial, investment, or other professional advice. The views expressed are strictly those of the individual and do not necessarily represent the opinions of the firm. Always consult with a qualified financial advisor before making any investment decisions. Investments carry risks, including the potential loss of principal. The content is based on current market conditions and is subject to change without notice. The firm is not responsible for any errors or omissions or for any actions taken based on this information. Past performance is not indicative of future results. This material does not constitute an offer or solicitation to buy or sell any securities.